So I want to start off this by saying this week was one of the hardest weeks trading for me. Not in the sense of I couldn't read price action, but my confirmations were lagging, or they just didn't happen. And because of that, I missed some really good moves. But nonetheless, it ended quite spectacularly today. So I felt like I wanted to share that experience with you. And the off chance that you had a bad week, and the off chance that you missed anything following your rules, it's easy to start spiraling when you miss stuff. So for me to you, it was hard for me too. So let's start off by identifying the order flow for the week, or the order flow that you expected for the week. 2, the liquidity objectives, or the drawn liquidity that we were anticipating coming into the week. And then what the setups actually look like. And if anybody has any questions, then we will, I guess, take a look at a couple stuff. So the week started on Monday, clearly. So coming into the week, we're looking at a drawn liquidity being lower. Order flow is bearish on NASDAQ. We're looking for price to trade into 14,500, all that good stuff. So automatically, just being rudimentary, if that's the weekly open, your drawn liquidity has to be below it. So failure swings below that red line on the daily chart. Number 1 and number 2. Obvious. Someone says they can't hear me. Can you guys hear me? We can.
Yeah, it's perfectly fine. Perfectly fine.
Okay, cool. So before we take a look at anything else, let me just push this to the left. Order flow is bearish. We're expecting us to reach lower. We're expecting a bearish week. The drawn liquidity, the most obvious liquidity levels to look for are this and this. That's what they are. Simple. So going through the week, I had these framed as where I wanted to see the market drawn to. And I think it should be clear why. I don't think anybody should not be wondering why I picked those and why we're looking at those. The drawn liquidity lecture should be clear. That's all we need from the daily chart. Or is it? This Monday here was the first time we had an up candle body since we left this dealing range up here. Since the market reaches for liquidity and imbalances, wait a minute, wasn't there a big liquidity void here? I wonder if it's the feed.
You're on the wrong feed, I guess.
Yeah.
It's on. Yeah, this is the one. Yeah.
So let me real quickly do this again. The week started here. Your drawn liquidity is here and here. Red line frames the opening price of the week. We just left this range inside here. So whenever price leaves a range, most times we're trying to think about if we need to retrace for another expansion or not. If price is going to expand or its price is going to retrace, we're going to look for if internal liquidity or imbalance is inside the range. So for simplicity, we can look at the range being that high down to this low. For simplicity, right? Make life easy for everybody. We could look at the high from here to here. Or for precision, you could look at the range from this high to this low. That would mean that's your dealing range. That means the first time we close below this candle is price showing willingness to leave this range here. So after Wednesday, August 2nd, you're not expecting price to try to close up here again. We're expecting it to leave. Nonetheless, that has happened. The new week started. You're expecting lower prices. We have a big up day in an area where you're not expecting price to try to go back above. This automatically becomes your bearish order block. The liquidity that's inside here, price has been offered to pair liquidity inside here. This is your daily order block. So on Monday, you wouldn't have known that clearly. So price will be reaching for something. We're going to go to a lower time frame and then come back to the daily chart to reference levels here, what happened and how we could have been involved. There we go. H1. Start of the week. This is how I would review my week if I was doing it alone. Monday, 4 a.m. That starts my weekly delivery. That can't be right. It's too far away. There we go. That one. I'm here. So 4 a.m. on Monday. This starts my week. We had an update and price broke low on H1, retraced and pushed and retraced and push again. Normal stuff. On H1, combining our weekly open plus lower downside objectives, it's nice to see the type of reaction that we have here. But this by itself doesn't tell us anything besides it's great in hindsight. This doesn't tell you how you could interact or engage with this price, and it doesn't tell you how can you leave this call and go about your business next week and it's capitalize on something we talked about today. So first thing we're going to look at here is what does overnight session look like on Monday. We're going to take a look at Monday's low. We're going to take a look at the dealing range and how all of this set up. In the past, I've mentioned a concept, one of my own making, not the Grim Reaper favorably, yep, that I call engineered origin. I'm not going to speak like extensively on it, but if you have remembered that from, or if you remember that from the DOL lecture, I'll touch on it here just to kind of frame what gave me confidence about direction and where my setup is going to form for this week. This here is Monday's low. This is the day that was the up day on the daily chart that framed your daily order block. I want you to take a look at the range of this, as well as when we close below here. It's going to be instrumental in what I'm about to explain. So I'm going to take this off and keep our focus on that up candle. Bodies, open, close, there. On H. So on Monday, here's the range of the daily candle, full range, body to body. Here's the low. We traded here and showed a willingness to take a up candle's low in bearish order flow, right? So listen to that carefully. In bearish order flow, price printed an up candle or an up day, then showed willingness to trade below that up candle's low. That's validating your order block. So if a daily order block is being validated, automatically, the first thing we're going to be thinking about is retracements to the order block and then short. If you want to frame a retracement here, you don't need many things. You could simply look at the high of right here down to the candle that goes, didn't say close, the candle that goes below this low. Okay, so I want to see how using the body of the daily candle here, we could frame 50% of the body here and be beautiful for that short. If we look at the range here from this high, 5 p.m., I'm going to include everything on the H1 chart. From 5 p.m. all the way down to the candle that goes below this low, which is this, 7 a.m. the next day. That gives you your dealing range. That gives you your dealing range. So the moment price is showing willingness to go below the daily order block and you start anticipating retracements, premium of this range automatically jumps out for you. But what's at 50%? 50% by itself is not going to do anything magical. Price is retracing, so it must be seeking either an imbalance or internal liquidity. Okay? The internal liquidity is going to be resting above here, these highs. Why these highs? Because we look at liquidity from a failure swing standpoint. So if you look inside here, when was the last time we took an H1 high? If we do that, we will see Monday 10 p.m. is the last candle that took a high. So every lower high after 10 p.m. Monday on H1 that does not take a previous hourly high will house liquidity. That. So if this market is reaching back inside this range for imbalances and liquidity, I don't see an imbalance here, but this is the internal liquidity you want to get taken. This trades towards the liquidity and fails, then we drop. This is bearish. We're showing willingness again to close below lows. That's commitment. So any retracements again should follow the same logic. Where are the internal liquidity inside the range? All above that high. This high is now a failure swing. If you frame your plan around just this high, it's just as good. This is just for precision. Okay. So we trade up, push again, fail, drop. Eventually we sweep the liquidity inside, expand. One objective has been met. So the next objective you're looking for is going to be this one. Nice and easy. But how do we use all of this to help us create a realistic plan that we can use to trade next week or any other time? Simple. I'm going to share again, an idea that I call engineered origin. If you've ever heard it anywhere else, you know where it comes from. Whenever price has a range or any type of delivery, all right, let me not say range. Whenever price has a delivery and the market is moving, there is an objective. We know that every time your drawn liquidity gets met, a new delivery starts. When you think about that, conceptually it makes sense. If we have a delivery, if we have an objective that price is reaching for, when it gets there, the objective is done. The objective was met. So the next thing price is going to do is start a new delivery and reach for somewhere else. That's simple. So when we think about it conceptually, yeah, that makes sense. It's easy. Yeah. What are you trying to say? What if every time a delivery ends, you could frame what a new delivery looks like? Simple rules. If we finished reaching for an objective here, this is what the new delivery looks like. Since we watch candles, it is very likely going to be the open price of the next candle after the objective is met that starts a new delivery. That's realistic to think like that as well. But how do you frame when a delivery objective is met? Well, if the market reaches for two things and two things only, imbalances and liquidity, you can use whenever we close an imbalance, a new delivery starts, or whenever we close and finish distributing in a pool of liquidity, a new delivery starts. So they deserve this. Don't worry, it's only 77 people on the call, don't worry. Who says I'm going to post it on YouTube? Maybe it's just for who's here. So when price reaches into its objective here, on this candle, 8 a.m., this candle here, the delivery ends. What delivery? The delivery to the sell side liquidity down here. That delivery ends once we close inside the sell side liquidity pool right there. So that means this candle here starts a new delivery. If this is starting a new delivery, this delivery is being formed in a market condition where you expect retracements. Retracements seek imbalances or internal liquidity. If the new delivery starts here, all right, it's going to get technical now. Let me take these off. If this is the last delivery here, that simply means from here to here is the most recent traded price range. If this retracement is going back inside here, you automatically know where you're going to look for your PDRAs. That also means this new delivery will create a range. And the range starts here. I'm going to move this line and put that opening price of that candle. This new range opens, sweeps the previous range low, then trades higher towards the objective. We have a high and a low creating a range. So this delivery has a range that's here and here. If this range that's created right here is efficient, the market only needs to respect 50%. If the range is inefficient, then the market is going to reach for the imbalances inside the range. If you can see just that, what I just said, your drawn liquidity will never elude you. It doesn't matter what time frame you use at all. And I'm going to show you that on a higher time frame, why I'm saying NAS was drawn to 14,500. So since the start of this new delivery, in this price range, what's the delivery like? Well, we went down in one candle, then we've been going up since then. Now, wouldn't that make everything above this here one-sided delivery? Since efficiency is framed around everywhere price is delivered to, it should have up candle body and down candle body. So right here, when we trade back to the weekly open and that hits, we create a swing high, the state of delivery changes and price starts reaching low. Wouldn't that mean the first drawn liquidity right now is for the market to fill in this imbalance since we're still inside this range? And that imbalance should be filled when we close at or below this candle's open. which means right here. That. So now we have a range. The delivery here is done. This range is efficient. Wouldn't that mean new deliveries are being started here? Of course. No. Since we are going to accept that definition, it means the start of a new delivery can be framed around that candle open. If, all right, listen, if we are looking at the draw to the downside or the objective to the downside being that imbalance. But what if you are overwhelmingly bearish and you believe the drawn liquidity to the downside is this low? Then it means your engineered origin or start of a new delivery is going to be this candle open. Now, how can you have two different starts of the delivery and how do you pick one? You decide what model you're trading. If you're trading this is specific to the guys looking at loops. If you're framing delivery based on loops being closed, a new delivery starts when the loop is closed. If you're framing your delivery based on liquidity being taken, a new delivery starts when the liquidity is taken. For this call, make it mechanical, since we have been looking at delivery overall, like flat delivery, not defining or distinguishing between them. This hits the objective, new delivery starts here. That means
we can take 50% of the body of two candles, right? That can also be done.
No, don't do that. No, don't do that. This here is going to create a new range just like this. It doesn't matter which of these candles you use to frame the start of the delivery. Your range stays the same. Okay, so the new delivery starts. Here's your range. If I'm looking for liquidity, liquidity is going to be above or below that range. That automatically means if my model is framed around hunting liquidity, when this high is taken, a new delivery starts. When this low is taken, a new delivery starts. Okay? In this case, price reaches higher and we have this liquidity being taken. This range is already efficient. Inside that range, the only price level where there's any type of quote unquote internal liquidity is this high. We get that right here, and there's no CSD, which means this is not the objective. We're reaching higher. But where else is liquidity resting above here? It's the obvious part. This high and that level. They get hit. For jelly, yes, you can use this for ONS. There you go. But again, because this is mechanical, you don't have to commit to looking for this liquidity or this liquidity, because as we know it, the algorithm is not one single function. It's made up of different functions that overlap together. One cycle ended today. God's kid said that. Yep, I told him. No, let me not laugh. Yeah, let's stay on track. So ended, price reached up, grab that liquidity. If you look at this starting a new delivery to reach up, so this new delivery is reaching for a higher objective, hit, then that high, that low creates your new range. Here. to here. That's your new range. Now, inside this range, right? Take a look at the price delivery. Even though this current delivery is being delivered here, sound like a whole lot of delivery. It's inside a range of price where we have traded before. So if a FVG gets created anywhere inside a range of price where we have traded before, you don't hold that FVG in high regard. You don't. FVGs inside an area of price where we have traded before holds little to no significance to me. Put the FVG down here and see what happens.
Can you repeat?
Oh, I'm saying FVGs inside a range of price where we have traded before holds no significance, because based on what we view as a FVG, it's usually an imbalance in accumulation or distribution. Either prices accumulating higher and there are gaps, or it's distributing lower and there are gaps. So if it was delivered higher and then lower, where is your inefficiency? Isn't that balanced? So there's a range. This FVG is not an FVG you hold in high regard, because this is being formed inside an area where the market was traded before. So what would you hold in high regard here then if all this FVG stuff shouldn't be looked at? Since the start of the delivery, we traded up, grab liquidity, big up candle. I don't want to see anything beyond that. Inside this delivery, you can see lots of logic for breakaway gaps to form. There we go. So here's that delivery. Here's that run lower. Again, you can look at this taking the liquidity and this starting the delivery, but I prefer closes. So this here took all that liquidity, and this candle here started a new delivery for today. So hypothetically speaking, right? If I was trading today, let me take off all these lines. If I was trading today, I would be trading a bigger, stretch this. I would be trading around a logic that this opening price is starting a new delivery. But this is an hourly chart, and I'm a scalper. How could I transpose this information to a lower time frame and capitalize? Once this candle closes, I have my range here to here. So I can look for the liquidity runs that takes place at or below this high or this low and look for CSD there. Now we drop to M5 because M5 plus everything we know is beautiful. Let's identify our range. If you ignore the time frame that this is an hourly chart, the same logic should jump out. If you're trading at M5 and I'm trading a daily profile, not an H1 profile that stretch across a couple of days or a couple of weeks, but a daily profile that's inside one specific day, I need the open price. Oops, almost marked the wrong time right there. I need the open price of this candle. This is my current range. Overnight session is here. I can look at the delivery inside here using the same thing. Now the twist is that while these engineered origins originate from a specific structure, meaning closes above or below a low, this one, among many others, originate in time. Time. That's why 4 a.m. starts to deliver every single day. That's why 4 a.m. is my true day. Tom, 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 tom. So if we know that this is EO and I'm reading the delivery since EO, real quickly we'll have EO high, EO low. A new delivery starts when we close below here or above here. No close, being held, closes, bam. So new delivery starts and this candle's open. Nice and easy. High to low, create me another range here.
Yo, sorry, what's EO?
It means engineered origin.
Oh, okay.
Sip of the sauce.
Yo, dude said, okay, he doesn't know what's going on.
So here's what I want you to see. New delivery starts here in this candle. Range created. Is this range efficient or not? Well, since the start of the range, there's been no up candles inside here. So I can look at that portion of price, up candle to up candle body. There's no up candle here. That's inefficient. Once an up candle is printed there, it will not only complete a delivery, but it will likely close in a delivery loop. But get into that later, or maybe another time. All we want to know is that this is the drawn liquidity if the market starts to trade higher. It rejects the imbalance and trades lower. No big deal. That rejection creates a range. Again, no big deal. Liquidity is below here. So are we accumulating the liquidity below here? I don't know. What would that look like? Order blocks being formed inside the pool of liquidity. This would be the first candle you would anticipate to be an order block. So let's say validated here, you go long here, stops at low. Nice logic, but we could do better than that. We could do much better than that. If this here is a low and a range low, when do we close below that? Here. So doesn't that make this the start of a new delivery? Too many delivery starts. Yes, there are way too many delivery starts for you to trade every single one. So you find a higher time frame, frame it around the higher time frame, and you trade in line with your higher time frame. We're gonna do this on a daily chart before I end this call. So this is the most recent start of delivery. I can move it from here because I know what the draw is. That's the draw. This is the start. If this is the start, price trades down, prints an down candle, sweeping liquidity. When we validate this, it's bullish. But where is the market reaching for if it goes higher after that? This imbalance, internal liquidity. And if we continue to reach up, this. But why this? Because this, let me take this off. This is going to be funny. This is an efficient price range. And if the range of price is efficient, we look at 50% to carry all the weight or do the heavy lifting. So 50% to be rejecting price. It is rejecting price. But for precision,
passes to the range makes it efficient, right?
say that?
3 passes through the range makes it efficient.
Deliver to buy side and sell side makes it efficient. Drawn liquidity is met right here. Well, drawn liquidity is reach right there. Everything is done. There was no up candles inside here to here. We now have up candles. Everything is good. So if the internal drawn liquidity is met and price is going to reach low, what would you be looking for here? These range lows that we're not taking. These failure swings that are inside here. Everything says this is going lower. CSD, short here, short anywhere here. That's your draw. Here's your trade. This level here might not look like much. Why did it stop there? Why did it just sweep this? Of course, we could make a lot of claims about it being that low, or we could go back to the daily chart and look at where did we expect price to trade to. Right at that candle's low. Hit it. So when we go back to M5, look at this. So now we're accumulating internal sell side or lower time frame sell side plus higher time frame sell side. We hit that level. That down candle's high gets taken. Would I sell to make a new low? Madness. Because the state of delivery is on buy side, and where are the ranges inside here holding liquidity? We don't know because we didn't check. But we have time. This is the first time we closed above all these ranges. Prince saw up candle. So that means this high to that swing low is my range. Nice and simple. This range has upside, downside, efficiency. Where's my internal liquidity inside here? As high as this candle. Right here. So let's see if we reach for that. Let's see what it does right there. There we go. At 132, I'd say not, Sniper. I'd say not. If you look at every time we create a range around EO, then close outside the range, a new range gets created, and you could always frame where your near-term drawn liquidity is going to be. If I happen to go long inside here using early entry CSD, that's my target. Profile 1 here lower. That's it. We didn't close outside here, so I can keep this range on. I could keep 50% of this range on if it's efficient. Premium to discount. If prices created a range and it's not breaking outside of that range, premium to discount all day, every day. We have our discount already. This guy. We have our old low. We have our order block. Everything here. Now, some folks will understand why the opening of this candle should be marked and nothing lower, because some person like to trade 50% of the OB every single time. But this candle and this structure says you only need the open price for an entry. So this is what our back is doing. Yes, Charles. Entry. Suffer some drawdown, that's fine because the oil is about to close. All the closes here. On M1, this is probably looking like a range and this same fractal. You know what I mean? Maybe the range started somewhere in here and then dropped down and then hits that, then pushes. Your draw is above here. We haven't closed above this as yet. Notice we haven't closed above that range high. It's just wicking above and below because of the time of day. If another big wick spikes up, this and this are the only two failure swings up here because all of these are already swept. 1 minute chart. $12. Here's your 12 o'clock. New hour starts, expect a new expansion. There we go. Down candle, push. Rain started. Maybe somewhere inside here, the rain started. Came down, hit this. Stops at the low. Now, this didn't get to your objective, but this got to internal buy side. So you don't have to commit to being a perfectionist here. This to that equals money in your pocket. So take it.
Can I ask a question?
That was a question. Sure you can. Kidding.
The AM session we had today, you said the drawn liquidity was the 50% of the DRO of the 4 to 8 AM. We usually target the top of the DRO. So I was I caught that trade, but I was waiting for it to go and take the DRO at the top, not at the 50%, only for the trade to reverse. I took something anyway, but
Understand?
Understand my question.
I think I understand. So what you are essentially trying to do is play a long trade that sweeps overnight session high. But today's delivery only required for price to reach into this portion of the delivery and at most 4 a.m. It did not require overnight session high. But don't worry, you're not the only person who anticipated overnight session high to be taken. A lot of persons snickering in silence also wanted overnight session high to be taken. I'm positive that if I didn't say it wasn't going to get taken, some persons would hold for that. Maybe somebody did hold and then got squeezed at break even. Who knows? Now, once you understand that, you go to a daily chart, it's the same thing over and over. So that means, when was the last time we closed outside a daily range? I don't know, but I don't have to guess. A range is a high to a low, and this went up. When was the last time we closed above a high? And that's a high, bam. That means this is my internet origin. Mic drop. Which means since this delivery went up, all of this is buy-sided delivery. There is no down candle between here and that. So that becomes my drawn liquidity until it happens. So the market retraces inside that little dealing range. Internal imbalance filled. This was the day I posted that NAS to 14,500, but I did not hold. So yeah, I traded very poorly in July and August. In terms, I didn't swing as much as I could have, but there's a push. On this day, my downside objective was to expand below here. Once we close below here, this and this is my draw. But the last range that we closed above, this is not the range low. If that's the range high, isn't that the range low? So wouldn't sell side liquidity be resting below the range low? But what failure swing is below the range low, since I love targeting failure swings? Survey says that. Now he's not very close to institutional 14,500. And that's how my drawn liquidity for 14,500 was born. It's growing up very nicely now, going into old age. But that's it. But what about the range before that? Same idea. When did we close above it? There. Where's my EO? There. Here, opening price of that guy.
So how do we know when it's not going to go above the ONS? And just the 4 a.m. or the 50%?
Look at it like this. The market reaches for liquidity and imbalance. If there is no liquidity above overnight session, it should not reach for it. Today, didn't have liquidity above. The market was already in an expansion protocol since it took yesterday's high, this high. It's reaching for lower now. So we're sitting at about 50% of the last range that we're in. We don't want to see any type of profile fives. We want to see an expansion through here. So let's see. There's no, the only thing up here that warrants a buy side run would be these. But again, this is me wanting to do too much. So I'm submitting to this going lower and only looking for shorts. But yeah, nice to review. If you go into every day on M5 and look at what we just talked about, you should see entries automatically form towards the area that you're going to identify as a drawn liquidity. Just look at these things. These are your drawn liquidity, and just watch how price prints a setup that runs for them. That's all. 2024, you won't need me anymore.
Will this
Thank
be
you.
posted
Kish.
anyway?
Thank you. Please kindly help us drop this on your channel, the recorded version.
Yeah,
We'll
because
see.
These are 2-3 watches. Yeah. Not more.
We'll see. So that completes my trading for this week. I hope you guys had a good week. If you didn't, I had a tough week as well. Enjoy the rest of your weekend, and I'll try to do these maybe once weekly if possible.
Thank you.
Bye-bye.
Respect.
Cool.
Yo, link me now. I need to ask you something. See?
Cool.
Oh, I had man, I didn't.
Oh, yeah, I said